people tend to invest based on emotions. For every winner, there's a loser in this game, right? So there's always someone out there who's more savvy than the other person. And so the question is, can you perform best just by having a feeling for what's going on in the market, or can you use data and science to try and more systematically and consistently outperform the market?
Hello, everybody. Welcome to the Mouthy Money podcast. I am joined today, as ever, by my good co-host, Chris Chu, who is Head of Consumer Finance at communications consultancy MRM. Chris, hello.
Hi, Ed. How's it going?
Very well, thank you. We've got a really interesting topic today. We are looking at investment themes, and specifically, I think the phrase that we used earlier together, Chris, when we were discussing this, was investing with your head versus investing with your heart.
Are you trying to say that my crystals won't work, Ed?
Perhaps, Chris.
My horoscope won't predict my financial future.
I think my sister-in-law really likes crystals, so if she has an investment crystal she wants to share it with me, then I'd be very interested to know about that. No, what we're doing today is we're looking at investment styles, strategies. We're going to start by thinking about what's going on out there in the market. What do things feel like? And then we're going to talk a little bit more about how can you take some of those emotions out of it? Is there a style of investing that really is about using your head, using specific, let's call it what it is, mathematical tools, essentially, to do the job of investing for you? To do that, Chris, I'm very pleased to say that we are joined by Daniel Gold, who is founder of investing app Stratify. Daniel, hello and welcome to the podcast.
Hello, thank you for having me here.
It's brilliant to have you on. So Daniel obviously is the founder of investing app Stratify. Daniel, just before we get into the meat and potatoes of today's chat, just tell us a little bit about yourself. Give us your background. Where do you come from to this investing app journey that you're on?
Yeah, sure. So my background is, my education is in mathematics. I did a PhD in algebraic geometry for my sins. But I've also always been kind of interested in, I guess, a range of things like everyone. So entrepreneurialism has been kind of a common theme. And also I've got an interest in sustainability. So my first business I started up was a solar energy integrator business, and I did that for 4 years, and it was a good introduction to being an entrepreneur, but ended up closing the business and then working in the city. So I was working in derivative pricing, and that's kind of where I saw this kind of opportunity to combine all of my interests to start up Stratify. That's where I got this introduction to how professionals were investing, and where the idea for Stratify came from.
Yeah. So this is what we're going to get into today. And this is one of the core themes. It's talking around a type of investing that normal armchair consumer investors, normal people who invest, really don't have very much access to. That is quantitative investing, to use the phrase. And we're going to call it quant investing because quantitative, I find an absolute mouthful to have to keep saying over and over. But let's set the scene a little bit first before we dig into quant investing as an idea and a concept. And Chris, I'm going to come back to you with this, and this is the head versus the heart investing. Set the scene for us a little bit in terms of what's happening in the market, Chris. What's going on out there in the world?
There's a lot going on out there in the world. From the investment standpoint, I was in so we have a regular Monday meeting at MRM where we talk about what's been speculated on in the media. And one of my colleagues who is focused on the investing space quite heavily came out with a really interesting indicative number. And this probably gets to the head versus the heart debate a little bit, Ed, in that there's been some speculation in the media that perhaps this AI boom is becoming a bit of a bubble. And he read a stat over the weekend, which said that when we approached the .com bubble bursting, that the S&P was valued at 31 times earnings. And at the moment, it's valued at 29 times earnings. Now, those two things are interesting historical correlations, right? But I felt at the time, I went, oh, that's a bit of a red flag. How do I feel about that? Am I a bit panicked about how overweight I am with the S&P? And do I think that there's a big crash kind of coming? And so I think that's probably the big speculation, right? Is there a correction coming because markets are trading at all-time highs? They seem to be somewhat divorced from what's going on in the real economy. There's a lot of pain out there on Main Street, to borrow that American term, rather than Wall Street or the British equivalent or the European equivalent, or wherever you're tuning in to see this. And so people perhaps think it might all be a bit too good to be true. So going back to that number, my immediate reaction was, well, what am I going to do about it? And because I didn't do anything as remotely impressive with my mathematical brain as Daniel, I got a C in GCSE maths and then put the thing down and went straight into humanities to read poetry and deal in vibes. I sort of see markets as stories, right? And act on feelings and have a think about whether or not that feels like something might be happening or something might be shifting. So that's where perhaps today is going to be really interesting, because I've always felt that sort of analytical side of what I'm doing is missing, or there might be too much emotion involved in what I do. And while I've gone for a general numbers-based bet, which is over a long enough period of time, my investments are going to go up enough, which I think has been statistically proven over time, or where markets can go down as well as up, and all the usual disclaimers here, but I'm confident enough in that truism. The idea that there could be some tools out there that could help me to remove some of my emotion around some of these things, and perhaps the fear, uncertainty, and doubt that can make bad investment decisions a reality, seems to be quite interesting. What about you, Ed?
So yeah, I think my own experience with investing, I mean, largely still been mostly through my pension of more short term having a look at it, but generally speaking, my forays into it have been very limited. I would say that I do feel like I quite easily could become a vibes based investor, where I just see something in the news or a headline and think, do you know what, I'm going to do that. Or no, yeah, well, that looks like a bubble, I'm going to get out of it. I think for the most part, what I've tried to do is actually divorce part of that in my main pension, which is I'm going to put this in one thing and I'm just not allowed to touch it or look at it. Just forget about it. Just leave it alone. Very diversified, global tracker, etc., etc. Forget about it. That being said, and we did a podcast we did some stuff around this recently. I have also admitted to having looked at the vibes of the world out there and bought some gold, which I will say at this point has gone up 17% in the past month.
So the vibes are working out.
We may or may not be at the top here. I don't know. So I have done a little bit of it. But I think, so look, coming back to the point you made about the bubble and all this sort of stuff, I'm not sure if we're really here today to talk about whether there is a bubble or there isn't. There may or there may not be, and I think people have to make their own minds up on it. What we're here to discuss today, and what Daniel's going to help walk us through is there a way to just remove that from the conversation and say, we're not worried about the vibes, we're not going to look at it from that perspective, we're going to take a cold, mathematical approach to things. Daniel, would you say that's kind of a fair analysis of what Stratify is doing, or what quant investing is?
Yeah, I think it is a fair kind of summary of what quant investing is about. And I think it's been a really interesting kind of discussion around how people tend to invest based on emotions and kind of different options that are out there to people. I mean, the big kind of story in the last few years was the kind of GameStop stock. That was the big kind of meme stock that started off this whole kind of meme approach to investing. And that was a big, what's the word? A lot of people lost out from that, right? It's for every winner, there's a loser in this game, right? So there's always someone out there who's more savvy than the other person. And so the question is, can you perform best just by having a feeling for what's going on in the market? Or can you use data and science to try and more systematically and consistently outperform the market? And so our belief is that you can use this scientific approach to perform better on average than you would have done on your own just by taking a feeling or a punt on the market. And so that is our approach to investing.
So let's step back here at this point, because I think this is a good point to do it, and break down in a nutshell, is quant investing? How does it work in a kind of practical sense?
Yeah, so the two main styles of investing are fundamentals investing and quant investing. So a fundamental style investor will look at doing data analysis on all of their investment opportunities. So they'll research the market, they'll research the company, they'll read reports, they'll kind of read around the subject. And that is a very time-consuming approach. This is, I think, the Warren Buffett style of approach, and that can perform exceptionally well, right? So the kind of message here isn't one is better than the other. there are two very good approaches to investing. However, that style of investing, it does require a good intuition, good knowledge, a lot of time, a lot of expertise, and is probably out of reach for most people. The other style of investing is quantitative investing. And this is the style of investing that at least I've seen most often in the industry. The investment banks in hedge funds, the sort of quantitative investment funds out there, which are using algorithms to determine what to invest into. And this is used by very sophisticated investors. And it's until now has been relatively out of reach to the mass market. The only way it's been accessible is through quant-based ETFs or quant-based thematic funds. There are some out there, and again, I'm not trying to preach any one style to anyone. There's a big market, horses for courses and all that. But if you want to have personalization in this style of investing, that has been inaccessible to the mass market. So if you wanted to define your style of investing and then systematically invest into it, that's something that's not really been served in the market until now.
And that's the key thing here, isn't it? Quant investing is very much something that institutions with resources who are able to build effectively what are complex products have been able to do in the past. But you've brought your experience and your background in mathematics and working with data and this sort of stuff to be able to provide this for normal investors like me and Chris, basically. So tell us about Stratify, just a bit about its journey and what it looks like today and what is available to users on Stratify.
Yeah, I think it's, as you said, it's trying to bring this quantitative, sophisticated style of investing to the mass market. So essentially, it's trying to take what we've seen done in these hedge funds, in these banks, in what we consider to be the sort of top echelon of investors, and break it down, make it accessible and enjoyable to use and affordable to the mass market. And so our approach has been a little bit different to others who've tried to do this that we've seen in the past. The typical approach we've seen to kind of get this style of investing into the market has been quite technical. It involves typically systems where you have to code up your strategy, and it's very complicated, lots of acronyms, lots of terminology. So we're trying to get rid of all of that and just make a very intuitive, fun to use, low cost platform where you can define how you want to invest, what your goal is, what your objective is. Try and make it in a language that people really resonate with. And then once you've defined how your style of investing and how you want to invest, the next thing we do, which is quite unique, is we show you a 10-year back test of what would have happened if you had systematically followed that strategy for the last 10 years. And if you like the look of it, you can invest into it. If it's not achieving what you're expecting, you can then start tweaking it and change parameters and then rerun the back test until you are happy with it. So that level of power and personalization and sophistication in your pocket, I think, is a game changer for retail investors. It's not something they've had available until now. And I view it as a toolkit. You can use it how you want to just follow your view of the market.
So with these kind of strategies, in my head, it conjures a system up where major stocks are being traded. They can be done. You do kind of hundreds of trades an hour sort of thing, or thousands, where you have this big scale constantly moving on the numbers and this sort of thing. With the Stratify approach, is it that intensive, or is it a bit more taking your time, seeing how things move? What is that kind of interactivity like for a typical user?
Yeah, we're more looking at long-term sustained wealth generation. So it's more long-term decision making. So we're not high frequency investing. That's typically done by hedge funds looking at microsecond data, high-paced markets like FX. So we're typically investing into equities and ETFs and taking a long-term view of those. The kind of decision making is done on daily data. The balancing is done on a monthly basis. This is something that we test over a long period of time, so we can see that it is consistently performing well in different market conditions. And so if we see something that's performing well sustainably, then we'll invest into it. So the message isn't that, we've got an algorithm that's going to always generate a profit on every trade. That's impossible. And anyone who says this doesn't understand the markets, really. So what we're trying to achieve is a profit on average. More than half the investments we make a profit. And we can see that in the back tests.
Yeah, it makes sense.
And is
The
this
thing about-
AI?
Oh, go
sorry,
on,
Ed.
Chris.
Is this
Yeah, please,
AI powered then? What's in this black box, Daniel? I'm just interested in, you know, so talking through the process, I would start and say, here are my parameters. Here's what I'm hoping to achieve. Here's my red lines in terms of where I want to be invested and the types of vehicles or companies that I want to be involved in. And then your system, powered by AI, will create a portfolio instantly that aligns with that. Is that correct?
Exactly that, yeah.
Yeah.
So, and it's important to define what we mean by AI as well, because I think typically AI these days, people think of LLMs or chatbot style AI. That's not the approach we're taking. And I've seen a lot of articles and papers talking about LLM-based investment strategies. I've not seen any that are particularly convincing based on sustainable long-term performance with a back test. So we're not convinced at the moment that that is the right technology for this job. What we're using is traditional machine learning optimization techniques to generate the underlying parameters that are used within your strategy. So let's say, for example, you invested into a strategy that's following the top US tech stocks that have the best momentum in the market. We'll then take that overarching approach to investing that you want to follow, and we'll see what are the best parameters that define momentum for the current market conditions. So momentum in the current market might be measured over 2 months. Momentum over a different market might be measured over 6 months. So that optimization process will constantly look at the current market conditions and dynamically generate the best parameters that give you the best risk-adjusted outcome.
And then you will suggest a series of shares or funds or whatever to invest within. And then what, would I approve that? And then you guys would go off and execute on those trades? Or is that something I need to do myself? How does that element work?
No, so you don't need to do anything, actually. We'll do everything for you. So we generate the signals, we execute them, and then construct your portfolio on a regular basis. We can keep you fully informed. So the system is very transparent. We show you the signals that are being generated, the trades that are being placed, the execution, the settlement. So it's all very transparent, but you can kind of sit back and watch it happening.
Wow. That sounds good.
What's interesting, this is a lot of the data that goes into something like this is freely available. You know, if I want to go and look at a 10-week moving average for a particular stock, that is something that I can find pretty easily in Google. The big difficult job here is A, harnessing that data in a way that's useful, and B, having the time to implement that into a strategy. And that's what you're offering here, isn't it? Is taking the work out of that, because that's what institutions are doing with that when they do quantitative investing. But for normal people, they just don't have the resources to do that on their own.
Exactly, yeah. And that's a journey I kind of went on and discovered through my own experimenting, and then kind of discovered that gap in the market. But I think everyone discovers their own challenges with investing, you know, whether you're just downloading these signals from another website and implementing them, or whether you're trying to calculate them yourself like I was and then implementing them. There is huge complexity and challenge in doing this systematically and consistently. And so that workload is what we're taking out of the equation. Because, you know, our philosophy is that, you know, we don't think people want to spend all day, every day thinking about investing and following the market. It's a lot of work. It's kind of impossible to do realistically. And it's also quite stressful. So I think what most people want is to have a system that will handle this behind the scenes, but still take into account their goals, their objectives, their vision, and let them get on with their day-to-day life, whether that's meeting their friends or doing their job. So that's what we're trying to achieve.
Yeah. Just thinking about the kind of the investing universe on Stratify. And I know you've got a few new updates that you've got now in terms of instruments on the platform. So what are the main investment assets that are available to users?
So we've launched the app with UK stocks. We're just adding in US stocks, and we've just got a partnership with WisdomTree to offer their ETFs in the app. So you'll be able to build a strategy with a focus on any of their commodities or their thematic exposures. We're also going to be the venue to offer fully automated WisdomTree model portfolios. So that's something we're really excited about offering. Another partnership we've just announced is with 21 Shares. So that is, you know, they are, you know, one of the leaders in terms of crypto ETN issuance. Until now, crypto is not something we've been offering in the app. but the FCA is changing the rules on crypto as of the 8th of October. They're going to remove the restriction on crypto exchange traded notes. And so we are the only company at the moment in the UK with a partnership with 21 shares to offer their ETNs in a retail product. So we're really excited about being able to offer that. And then you'll be able to build a strategy which focuses on crypto, so Bitcoin and Ethereum exposures.
And you'd be able to put that all together as a part of a wider portfolio, so you can blend those with other strategies as well.
Absolutely, yeah. So we're moving more towards this whole wealth management approach where you can take a holistic view of your wealth and have a multi-asset strategy focusing on, a different focus on stocks in different regions, different thematic exposures, commodities, crypto, and money market funds, and plenty more in the future.
So how do you glean people's preferences, Daniel? Is there a questionnaire at the start, or I'm interested in? Because if you sat here and asked me what it was, I could talk for 45 minutes and say, go long for a long time and try and do some ethical things whilst also getting the money I need to potentially retire. That's kind of it, really. Like, I would like to be more sophisticated than that. And, probably doing this with Ed and speaking to good people like yourself, I am getting there. But, is it 10 questions? Is it 20 questions? Is it, how do you go about understanding what people's preferences are?
Yeah, it's a good question. And I try not to think about it in terms of questions because that sounds like, a bit of a static and step-by-step process. It's more iterative than that. So, our first screen for creating a strategy is just about understanding your goals. So we ask you what your risk appetite is, what your time horizon is, how much you're looking to achieve, and what goal you're working towards. That's just to frame the whole strategy and give it some kind of personality. Let's say I'm saving up to pay off my tuition fees in the next 5 years and I've got to save up 10K, right? So we know what you're working towards. After that, we show you a starting point strategy, which is aligned to your risk appetite. So we'll show you a momentum strategy in your risk appetite, looking at the broad market. We'll show a 10-year back test or a 10-year forecast, and you can then start tweaking it and changing the parameters until you're happy with it. So if you want that to focus on US stocks, you can change that. You can then give it a focus on crypto and gold. You can change the risk appetite. You can change the time horizon. You can set some exclusions, some limits. So there's a great deal of customization you can then start playing with. Each time you change something, you can run a back test and see how that changes the performance. When you're happy with the result, then you just click invest. And we fund the strategy and then generate the signals, start investing. And then you watch it on a regular basis. And behind the scenes, it's doing a lot of work for you, right? It's analyzing the whole market. It's analyzing your portfolio and it's deciding what to buy and sell. And so you can watch it doing all of that.
So I think sort of bringing it back round to where we were at the start then, talking a little bit about uncertainty in the world and not knowing whether things are going to keep going up or whether we're going to have a downturn. With this kind of strategy, this approach to investing, how differently does that perform in a scenario where things are not necessarily, things aren't maybe going up, if there is a bear market and stuff turns down? Obviously, you've probably you've not run it. You might have run it through this scenario, tell me if I'm wrong, but things have been going up more or less for a while now. So how different do things look when stuff is more difficult is, I guess, what I'm trying to ask.
Yeah, no, it's a great question. And I think the main justification we put forward to any investment strategy is a back test. And back tests some people view them with skepticism because most of the time when people show you a back test, it's performing very well. I think we get around that criticism by the fact that we aren't showing any back test in particular. You define the strategy, you run the back test. It will perform however it performs, whether that's good or bad. We'll show it to you. So we're fully transparent. And that's, coming back to this toolkit concept I was talking about. This back test runs for up to 10 years. So you can see it performing through various different economic cycles and you can see how it handles downturns during that period. We can go one step further than that as well. And we've been running our strategies for a year now. The longest running strategy we have has performed exceptionally well, actually. It's up 30% over the year and that beats the benchmark we're investing into by 20%. So we're really happy with that performance. at the start of our business in that period. And we can see that there was a dip, we're not immune to the market. Like, so it did dip during that time, but we also saw that it recovered faster than the general market. And since then has accelerated growth much faster than the market. So we can empirically test this.
Yeah. So in a sense, does that, I mean, when you have a period of adversity like that, and often, as we say, with that emotional driven investing where people see something happening and people start selling, and then it creates a bit of a snowball effect in the market. Does the algorithm, does it almost spot opportunities where stuff's being oversold perhaps? Or because you pointed there to it recovered faster, that to me suggests that maybe it is finding stuff that's been oversold by what are effectively emotional sellers, or even institutional forced sellers, which is not an unusual thing, because often funds will have to liquidate bits of their portfolio to ensure that they have the right levels of liquidity, and they have this kind of stuff. Will it find some of those opportunities for you?
It will do that and more, actually. So a lot of people during this period were selling at the worst possible time because there was so much negativity in the news. People thought it's just going to get worse and worse and worse, and then it rebounded. So the strategy won't have that emotional reaction to the market. It will take a cold, systematic, methodical approach based on what it's learned from the past experience. And so it didn't exit all the positions during that time. Plus, it decided to buy some stocks which were quite undervalued at the time. So it's kind of a combination of both. And I think that's why it performed quite well in the recovery period after that event.
Yeah.
That tariff tantrum is a really good example. Sorry, Ed, but I remember thinking at the time, even at the top level, how emotional this all is, because there was absolute panic. It really is emotion drives. And obviously there was real data at hand here in terms of the impact tariffs could have on all of this. The central question was whether or not the bond markets could put a muzzle on me a bit, I suppose. And so it proved, but not without sort of a lot of wailing and gnashing of teeth. But this idea that you could keep your calm there, or that you were confident that whatever is managing your investments could keep calm and ensure it's positioned to come out of anything like that in a better possible way. At that time, I think I absolutely would have bought into that. And so I'm very interested in this notion of, being able to set the parameters. So the story, the direction of travel that I believe that this is going in, but then having this assistant in the form of a Stratify portfolio, being able to spot those signals, to be able to take advantage of those moves faster than I can as a busy man with a job and 2 kids and a wife and, an interest in a football team and all that kind of thing, that I just don't have the time to dedicate to this. So it's really interesting, all of that. And I think that that tariff tantrum was a good example of that, where sometimes you can feel like the world's imploding and actually you just need to hold your nerve a bit. And what better way to hold your nerve if you don't have a nerve in the first place?
Yeah, that's exactly, I think, where Stratify can help. It can take the stress out of this style of investing. And I think that was quite a stressful period for a lot of people.
Yeah.
So I think to round things off now, for anybody really who's interested in checking out the Stratify proposition, because I mean, certainly for me, it's something that's kind of piqued my interest now, and I'm going to look further into, having already downloaded the app, I will say, Daniel. Give us a bit of just a practical, what do things like fees and stuff like that look like on Stratify? How does that aspect of it work?
Yeah, so when you create a strategy with us, we have a freemium model, so you can sign up and use the app for free, and you can create one strategy for free. In that strategy, we charge 0.9% AUM fee, and inside the strategy there's no kind of hidden fees. We invest directly into equities most of the time, so there's no fees for holding those, and there's no trading cost. So the strategy will trade as much as it wants without any commissions on those trades. We'll have subscription tiers. You can pay £9 a month and then get a £10,000 AUM allowance. So you can invest up to 10K without paying any AUM fee. You can also create 3 strategies. You get access to more advanced strategies. And then we have a £19 a month tier where you can get just more strategies, more advanced features, higher AUM allowance. You can also do soft directed investments. We charge £2 per trade if you are investing on your own. And the other point is a minimum of £100 to create a strategy.
Okay, cool. Really good. But and just to finish off, we'll put some links in the comments and stuff so people know where to go. But just for listeners, where's the best place to find out more information?
So you can go on our website, www.stratify.io. That's Stratify with a PH. You can, of course, find us on the App Store and the Play Store. You can find me on LinkedIn. I'm very happy to have a chat with anyone. And we've just launched a campaign on Crowdcube if you're interested in following the business more closely.
Brilliant. Well, we'll put links to all of that in the comments, as I said. Chris, any kind of final thoughts? Do you feel like you're going to invest with your head now rather than your heart?
I'm going to take a look at it. I think I'd quite like to just follow this over a period of time and see how my heart and my head can be melded together into a winning investment portfolio. That feels like the best possible way of doing it. I'm really interested in this idea of looking back over the previous 10 years as well, Daniel. I think that's really fascinating, just to give you a sense of, inevitably I mentioned that, my GCSE in maths was a C, and then I went off and read books, right? So stories, I'm big into stories and narratives. It's how I see the world. So, the idea that you can look at something and kind of pick up the threads of that story and then take it forward into the future with hard numbers below it and something able to execute on it far more regularly and far more accurately than I ever could. That to me feels, well, it's exciting, if I'm honest. I quite like the idea of that, being able to be far more involved and bring my own thoughts to bear, but with this powerful tool in my pocket. So, yeah, I'm going to take a look at it, Ed, and then I'm probably going to have to start seeing what you've done, and then we can gloat at each other.
You can compete.
Yeah, exactly.
Yeah, exactly. Yeah, see how we get on with it. Brilliant. Well, I think that just about wraps us up. It's a really interesting idea. I think definitely a bit of a diversifier on a diversifier, isn't it? Just taking we talk about diversification a lot and managing risk and this sort of thing. It comes in many different formats, and the risks can come down to investing in one way and putting too much difference on that. So actually, if you can invest in a different way, I think that can be a really interesting way of looking at it. Daniel, thank you very much for taking the time to chat with us and teach us more about Stratify and quant investing and that kind of thing.
Thank you for having me. It's been great talking to you.
And Chris, thanks as ever. We will see you all again very soon. So with that, thank you and goodbye. Thank you for tuning into the Mouthy Money podcast. Don't forget to hit like and subscribe on all our content. Follow us for more on your preferred podcasting channel, including Spotify, YouTube, or Apple Podcasts. Stay in touch by following our social channels on Instagram, TikTok, and LinkedIn. And don't forget to subscribe to the Mouthy Money newsletter on mouthymoney.co.uk. The Mouthy Money podcast is produced for general informational purposes only. It should not be construed as investment, legal, tax, or other forms of financial advice. If in any doubt about the themes expressed, consider consulting with a regulated financial professional for your own personal situation. Past performance is no guarantee of future results. Investments can go down as well as up, and you may get back less than you started with. Never invest more than you can afford to lose. For more information, visit fca.org.uk/investsmart for more. Thank you.